Hello and welcome to another intrinsic stock analysis. Today, we'll talk about the Aaron's Company stock, ticker symbol AAN, and why I will make an order to buy 200 shares. But before we do that, please remember that this video is not financial advice and for entertainment purposes only. The Aaron's Company is an American lease-to-own retailer operating 1,276 retail stores around the United States, and recently acquired BrandSmart USA stores, which are basically another retail chain stores. The company leases and retails furniture, electronics, appliances, and computers, and became public at the end of 2020. When we look at the 2022 revenue sources, we see that 41% came from furniture, 31% appliances, 25% electronics, and 3% other merchandise. When we check the year-over-year changes in revenue, cost of revenue, and the net income, we find that 2022 revenue is the highest in the past 5 years, and the cost of sale in the gray line is following the growth of the revenue. But the net income decreased in 2022, and actually it went negative. Usually Wall Street doesn't like that when it happens, so I'm not surprised that the stock declined after releasing the 2022 report. Checking the annual growth of the free cash flow, 2021 free cash flow took a nosedive. In my opinion, the decrease in free cash flow in 2021 is the main reason that started the decline in the stock price, because the stock went down by about 38% year to date and about 67% since it became public. The good thing is that 2022 free cash flow grew compared to 2021. Also, when I checked the last quarterly report, which is the Q3 report of 2023, the free cash flow and net income continued to grow, which is good news. But the total revenue of the first 9 months is lower by 3% compared to the first 9 months in 2022, which caused a significant drop in the share price. In the same week that the Q3 report was made available to the public, the stock price declined by about 22%. Going back to the analysis report and moving on to the debt, we don't have to worry about the debt because it's only 13% of the company's assets, and the company made about 51 times the interest expense that they had to pay in 2022. So in other words, they can afford to service their debt easily. Moving on to the outstanding shares, as the graph suggests, the company is buying back its shares, and since the company became public, they bought back about 11.5% of the outstanding shares. When we check the dividends, we see that this company is a dividend company, and it seems that every year they increase the dividend by about 5 cents per share. Because in the third quarter report of 2023, the total dividend so far is 37.5 cents. So with the fourth quarter dividend, it seems that the total dividend for 2023 is 50 cents per share, making the expected dividend yield 6.9%. Now let's forecast the revenue and the other forecast keys that we need. The safest way to forecast the revenue is to find an element in the financial statements that the revenue depends on. In this case, I'm using the total assets to revenue ratio or the assets turnover ratio. Since the company recently became public, I will use the average of the prior 3 years for this ratio. This will give us about $2.3 billion in revenue. For the free cash flow to revenue ratio, I will use the average of the prior 2 years, which is 2.6%, making the total free cash flow about $60.4 million. I will use the outstanding shares in the third quarter report of 2023 and 5% return investment ratio. Using these 5 forecast keys, the free cash flow per share is $1.99, and the intrinsic value of the stock is $39.83, making the stock undervalued by about 82%. If we change the return investment ratio to 27.5%, the intrinsic value is very close to the market price, so now we know the market return investment ratio. I should mention that this is a conservative valuation because in the third quarter, the cash flow statement, we can see that the free cash flow in the first 9 months is little over 80 million. And our forecast is only 60 million for the whole year. Of course, we don't know what's going to happen to the free cash flow in the fourth quarter of 2023, so I wanted to be conservative and not consider the third quarter free cash flow. And as a result of this conservative analysis, I like this stock and I want to buy 200 shares for $7.22 per share. Let me know what you think about this stock and analysis. Have a good day or night, and see you in another video.